Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Equinix Inc. Annual Report. Equinix is a company that provides various businesses and services to connect the world digitally. At its core, it offers digital infrastructure, which enables innovations that improve our daily lives. This includes data centers that serve as hubs for storing and processing vast amounts of information. The company's interconnected ecosystems allow different organizations and communities to come together seamlessly, fostering global connections. Equinix delivers cutting-edge AI solutions quickly and efficiently, making it an ideal partner for businesses looking to stay ahead in the digital landscape. By providing these services, Equinix empowers innovations that enhance our work, life, and planet, ultimately connecting economies, countries, and communities worldwide. Unfortunately, I do not have access to the text you provided. However, I can provide a general essay on what may cause a stock price to remain stagnant over a period of time. The stability of Equinix Inc.'s stock price in the past year can be attributed to several factors. One possible reason is the company's consistent financial performance, which has not shown any significant fluctuations that would impact investor confidence. This stability in earnings and revenue growth may have led to a lack of volatility in the stock price. Another factor could be the company's strong market position and competitive advantage in the data center and interconnection services industry. Equinix Inc.'s dominance in this space may have insulated it from external market pressures, resulting in a relatively stable stock price. Additionally, the company's strategic investments and expansion plans may also be contributing to its stable stock price. By continuously innovating and expanding its offerings, Equinix Inc. is likely maintaining investor interest and confidence, which can help stabilize the stock price. It is also possible that market conditions and overall economic trends have not had a significant impact on Equinix Inc.'s stock price. The company may be benefiting from a stable macroeconomic environment, which has allowed it to maintain its growth trajectory without experiencing any major disruptions. In conclusion, the stability of Equinix Inc.'s stock price in the past year can be attributed to a combination of factors, including consistent financial performance, strong market position, strategic investments, and favorable market conditions. Equinix Inc. market capitalization of $85 billion is significantly larger than the average industry peer of roughly $14 billion. This shows that Equinix Inc. holds a significant advantage in their industry. Equinix Inc. trades at a higher price-to-earnings ratio of 80 times and a higher price-to-book ratio of 6.02 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 61% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 2.16%. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth for Equinix Inc. can be attributed to the increase in colocation revenue across its various segments. In 2025, the Americas segment saw a significant rise in colocation revenue by $209 million, while the EMEA and Asia-Pacific segments also experienced increases of $111 million and $97 million respectively. However, not all areas of Equinix's business have seen growth. The company has reported declines in certain revenue streams, including interconnection revenue in the Americas segment, managed infrastructure revenue in the EMEA segment, and other revenues in the Asia-Pacific segment. These declines were relatively small compared to the overall increase in colocation revenue. It is worth noting that impairment charges had a significant impact on Equinix's financials in 2024, with $131 million recorded. While this may not be directly related to revenue growth or decline, it highlights the company's efforts to address any potential issues and maintain its financial health. Overall, the data suggests that colocation revenue is driving Equinix's growth, while other areas of the business are experiencing declines. The net income of a company experienced significant growth between 2024 and 2025. According to various reports, the net income increased by 66% to $534 million in 2025 compared to 2024. This increase was also reflected in other metrics, with net income rising from $814 million to $1,348 million, 65% increase, and from $975 million to $1,508 million over the same period. The profit margins of the company also showed improvement during this time. While there were some variations across different regions and metrics, overall, the profit margins seemed to be increasing or stable. For instance, America's adjusted EBITDA increased by 11%, EMEA adjusted EBITDA rose by 13%, and Asia-Pacific adjusted EBITDA grew by 7%. Additionally, AFFO attributable to common stockholders saw a 12% increase from $3,356 million to $3,761 million. However, segment-adjusted EBITDA margin did decrease slightly from 46.7% in 2024 to 49.6% in 2025. The reasons behind these changes are not explicitly stated in the provided information. Nevertheless, it can be inferred that the company's financial performance improved significantly between 2024 and 2025, with net income experiencing substantial growth and profit margins showing overall stability or increase. The company is indeed generating positive operating cash flow. This can be seen in the significant increase in cash flow from operations between 2024 and 2025, with a total of $662 million more in 2025 compared to the previous year. Additionally, the net cash provided by operating activities has also shown an upward trend, indicating that the company is able to generate sufficient cash from its core business operations. This positive operating cash flow is a crucial indicator of a company's financial health and stability. The company's debt level and interest expenses have undergone significant changes over the past year. According to the financial reports, the total debt has increased from $13.36 billion in 2024 to $19.06 billion in 2025, indicating a substantial rise of $5.7 billion. This increase is attributed to the issuance of senior notes worth $18.4 billion and other loans payable, amounting to $703 million. In terms of interest expenses, there has been a notable increase from $493 million in 2024 to $606 million in 2025, representing a rise of $113 million or 23%. This significant jump is due to the increased debt level and higher interest rates. The company's interest expenses have also seen a year-over-year increase of 15% in 2025 compared to 2024. The data suggests that the company has taken on more debt, leading to higher interest expenses. While the exact figures for some years are not explicitly mentioned, the overall trend indicates a substantial increase in both debt level and interest expenses. The financial performance of various regions has been analyzed, revealing both positive and negative trends. The Americas region stood out as a top performer, with a 6% growth in sales, 7% constant currency, and significant increases in revenue and segment-adjusted EBITDA by 2025. In contrast, the Asia-Pacific region struggled, experiencing decreases in revenue and segment-adjusted EBITDA for both 2023 and 2024. This decline suggests that the region is facing challenges in generating sales and profitability. The EMEA region showed mixed results, with a notable increase of $163 million, 5% growth in sales, but a decrease of 12%, minus 14% constant currency, in non-recurring revenues. Despite this, the region's revenue and segment-adjusted EBITDA are expected to rise by 2025. Overall, while some regions demonstrated strong performance, others faced difficulties in generating sales and profitability. Management's outlook for Equinix Inc. is one of strategic alignment and investment in key areas. The company has initiated a restructuring plan to realign its organization and invest in growth opportunities. This effort aims to drive future success and improve operational efficiency. In terms of financials, the company's revenue recognition policy follows ASC 606, which focuses on transferring control of goods or services to customers. Management is also actively managing its debt facilities, with a total principal balance of $686 million as of December 31, 2025. The effective interest rate for senior notes ranges from 1.46% to 2.25%. The company's strategy also involves investing in share-based compensation plans, which had a total value of $1.4 billion at the end of 2025. Additionally, management is exploring opportunities to wind down Equinix Metal by June 2026. Overall, management's focus on strategic alignment and investment in key areas suggests a commitment to driving long-term growth and success for the company. Acquisitions and divestitures are crucial components of a company's growth strategy. In recent summaries, several acquisitions have been mentioned that align with the company's expansion goals. The company has acquired new data centers, operations, and real estate for development, as well as invested in power and intellectual property investments. These acquisitions aim to expand the product portfolio through new offerings and enter new markets with complementary businesses. Additionally, joint ventures with third parties have been established through partnerships, joint ventures, or other entities. However, not all acquisitions are successful, and divestitures may be necessary. The company has discontinued its Equinix Metal product, indicating that some investments do not align with the company's long-term goals. Furthermore, potential disposal of joint venture assets may occur due to partner actions or disputes. In summary, the company's acquisition strategy focuses on expanding its presence through new data centers, real estate, and complementary businesses. While divestitures are a necessary part of this process, they aim to optimize the company's portfolio and resources for future growth. The company's financial history reveals a consistent pattern of dividend payments. According to the extracted summaries, there are multiple references to dividends being paid out by the company, as noted on pages 45, 50, 51, 61, and 119. This indicates that the company has prioritized returning value to its shareholders through dividend distributions. In contrast, there is no mention of share buybacks in any of the provided summaries. This suggests that the company has not utilized this method for returning capital to its investors. Concerns about inventory buildup and supply chain disruption are prevalent in the industry. Potential chip shortages due to increased demand for AI infrastructure could delay customer server deployments, page 13. Rising construction costs, labor shortages, and raw material scarcity are also causing issues with data center equipment availability and delivery, pages 23-24. Supply chain disruptions are further exacerbated by global challenges such as tariffs and countertariffs, leading to rising costs and delays, page 13. Power outages and limitations on transmission or distribution of power may harm business operations, affecting customer relationships and reputation, page 14. The inability to obtain financing on favorable terms or at all is also a concern, page 27. The cumulative effect of these issues could result in inventory buildup, difficulty finding replacement products, and continued high inflation. Global supply chain challenges are likely to impact the delivery of data center equipment, leading to potential delays and disruptions, pages 49. That concludes the financial summary for Equinix Inc. Feel free to comment below, and I will be happy to answer them when possible.